three letters, AAA or D, can open or close the doors of opportunity for any business. What do they really mean and who decides them? Welcome to Decoding Credit Rating, where we break down how credit rating works, why they matter, and what they say about the company's financial strength. A credit rating isn't just a mark on paper. It's a reflection of your ability to meet financial commitments. Those three letters can shape your borrowing cost or your reputation and even your growth story. The purpose of this series is simple: to explain credit rating in a way that's easy to understand, whether you are a business owner, a banker, or a student of finance. A credit rating is essentially an opinion, a professional independent view on the likelihood that the entity will meet its debt obligation in full and on time. It's not a guarantee, not assurance, but an independent assessment based on structured analysis. Rating provides a common language of trust, helping lenders, investors, and even regulators make informed financial decisions. Before credit rating came into existence, lender had limited means to judge the creditworthiness of borrowers. Information was scattered, inconsistent, and often unavailable. Rating filled this gap. They brought transparency and standardization that allowed banks and investors to compare companies on a uniform scale, assess default risk, and take lending decisions faster and more confidently. For companies, a good rating can mean lower interest costs and a easier access to fund. At the same time, for investors and lenders, it provides assurance that their money is being deployed wisely and safely. The concept of credit rating in India began in 1987 when CRISIL was established as the country's first rating agency. It was followed by ICRA, and then we got CARE rating, and then we got India ratings, and then we got SMETA ratings, which is now renamed as Equity ratings, and then we got BRICO ratings, and after a few years we got Informatics, and then after a gap of again 8 to 9 years, we have recently SEBI has given permission to ESSER to operate as a rating agency. But over the time, they expected to cover a wide range of products: bank loans, commercial paper, fixed deposit, structured obligation, and many more. Today, almost every debt instrument or large loan in India is linked to a credit rating. The system has evolved from a small regulatory initiative into a vital part of India's financial ecosystem. A credit rating symbol says AAA, BBB, or D. Summarize how strong or weak an entity's ability is to service its debt on time and in full. Higher rating indicates stronger capacity to repay, while same time lower rating signals high risk. These symbols are easy to read, but behind them lies a detailed analytical process examining financial statement, management capability, industry risk, business model, and even future cash flow projection. In short, a rating captures both numbers and judgment. Credit rating impacts everyone, directly or indirectly. For businesses, they affect borrowing cost, loan approvals, and reputations. For investors, they provide comfort and comparability across instruments, across clients. For banks, they form a critical input in assessing credit risk and capital adequacy. And for regulators, they strengthen the overall stability of the financial systems. Rating makes the flow of capital more efficient, connecting businesses that need funds with investors who can provide them based on trust. Every borrower, lender, and investor is touched by credit rating. They affect how usually you get funding, what interest rate you pay, and how much trust you command in the market. This is Decoding Credit Rating, a space where we make sense of how ratings are assigned, how agencies operate, and what those symbols truly means. In our next episode, we will begin with basics. What exactly is a credit rating, how it is assigned, and what the process looks like from the start to finish. Because understanding your rating is the first step to managing it.